Welcome to the Ranchonomics Podcast, where we empower you to build a better ranch and transform your operations into a thriving business. I'm your host, John Haskell. Let's get started. This is part 2 of an interview we started last week. If you haven't already, we encourage you to go back and listen to part 1, and we're going to take off from where we left off. So then with all that in mind, what should we be looking at in terms of financial metrics? And tell me again, you were a professor of finance, correct?
Yeah, ag finance and entrepreneurship actually here.
Excellent. And I find it fantastic that you have all of this other stuff rolled in here, right? You're not so narrowly focused on the finance that you ignore all of that because you keep seeing the same thing over and over again, right? Finance is definitely important, but all of these other factors, many of which you have already listed, are non-finance, right? Those contribute a lot.
And matter of fact, I tell people on problem credits, ag credits, the non-financial factors will move a credit from performing to non-performing twice as fast as the financial factors.
Interesting. Okay. Give us a little insight into why that is. Is that because the financial factors are easier to fix?
You know what will happen is, I'll just give you a couple examples. A divorce can knock you down, disability, death, disinterested.
Yep, the
words,
D's. Yeah.
Yeah. Boy, a big thing that's happening now is drugs, alcohol. But you know a big one that's happening, John? Particularly males from about 25 to 45, gambling.
Yep. I've heard that. That's the fastest growing cause of bankruptcy in the U.S. right now is gambling.
And what's happening is you'd think, wow, they go to Vegas or Reno. No. It's sports gambling. And it's so easy to
from
do.
Home.
And you know what you do? You get your fix. You get your adrenaline. You know what I tell people? Get your adrenaline by performing in the business. But you know what Buffett also said? Are you building a cathedral or are you at the casino? Gambling's like being at the casino, quick fix. But a cathedral takes time to build it and evolve. And so some of these non-financial, that behavioral acuity is it takes I call it transformative, not overall success overnight. And here's the other thing. People often chase the next big thing. Oh, there's 2 questions I despise. What's the next big thing? And should I be an LLC? Everybody thinks LLC is going to cure all.
That's going to save it, yes.
Yeah, save the problem. So those are some of the non-financial factors that, boy, can change a bottom line extremely quickly.
Okay, so let's focus on the financial factors then for a bit here, and then we're going to come back to some of those in more detail. So what should we be paying attention to? What are the KPIs we need to be looking at? Should we focus?
A KPI that I think is very important is net profit margin. And, it's defined, differently, but we kind of look at, revenue costs, including depreciation. What's the net profit margin? Because that's what it's all about. And one of the things that, we aspire to do is, be around that 8 to 10% on the net profit margin. Some of the good years, that'll move up to 15. Hey, you're going to have, in 10-year period, John, you're going to have 3 years that things just don't line up, But if you can kind of bat 70% on your net profit margin, be in those ranges, you're going to be ahead of a lot of people on out there.
Hang on one sec. Let's just make sure we clarify. So that is total revenue minus direct costs, minus overheads, and minus book depreciation, not necessarily tax depreciation.
Exactly.
Okay,
Do
good.
not go tax record depreciation.
Yeah. Okay, good. Want to make sure. And what do you see as an average there? Is the average kind of in the minus 2%, plus 2% range?
Yeah. In other words, I will see it in that range. The peak performers, though, are up in that 8%.
Yeah, in the 8 to 10. Yeah. Okay.
Yeah,
I just want to make sure we draw a difference between the average and the high performers.
Yeah. And, if you plan on being average, you'll be out of the industry in 5 years.
Yeah.
I often say that. So I got challenged at our creamery. We do the best, average, and worst case scenario on cash flows. Well, guess what? The young management team challenged me. They said, we're going to do the best of the best and put some real aspirational goals. And you know what I said? And the other older, it can't be done. Well, in the past 36 months, 31 of the 36 months, it's exceeded the best of the best.
Good.
But, John, the 5 months that it hasn't, you know what we older folks will say? Wow, we told you so. But on those net profit margins, and again, there's a lot of little things that contribute to it, which will, hit another, podcast. I think another one, if you're borrowing money, is the famous coverage ratio. In other words, simply put, it's your repayment ability to your debt service commitments. That's principal and interest. And, I've worked with lenders over the years. Matter of fact, the green light, yellow light, red light,
Yes.
that all came going to class one morning when I went through a late yellow red light and the policeman was there. But fortunately, I played in the NBA, Noontime Basketball Association. He played in it and he just laughed and let me go, But I think this is very, very important. And one of the things that you strive to do, kind of a green light, is 150 to 200%. In other words, your repayment ability is 2 to 1 of your, or 1.5 to 1 of your debt service commitments. That yellow range, 110 to 150. Red light, though, is under 110%. Now, got to tell you, a lot of our row crop industry, the average is now under 100%. That's why they have to come back in and refinance. In the beef industry, she better be up there pretty strong. And, the way that cycle has been going. But that's a metric not only your lender's going to look at, but it's very, very important. We look at it in our business, and I know on the creamery, it's 338% right now.
Good for you. Yeah. Okay. And let me just define this real quickly for our listeners. We talk about it, you say 150 to 200%. We talk about that as a debt coverage ratio of 1.5 to 2. So all we're doing is moving the decimal point there. Same exact criteria. And actually, we got those numbers from you. And then I want to make sure everyone understands this is net operating income. So this is total revenue minus direct costs, minus overheads, minus book depreciation. And then that number divided by the total of your annual long-term debt payments. So whether you pay them, if you pay your mortgage monthly or you pay your mortgage annually, most of us in ag make annual payments. Sometimes it's twice a year payments, but either way, we take the total of that principal and interest, divide the net operating income or the net operating income by that number. And that's how we calculate that ratio.
No, exactly.
Right. Very good.
And one of the things is sometimes you have to add interest and depreciation back in there to get that repayment.
Correct. Yeah, that's right.
Repayment ability.
The idea there being that our plan is to have more profit than we need to service our debt.
Exactly.
Okay, so why?
Then we build a cushion in there.
Yeah, okay. So why do we want a cushion? Why can't it just be one and we're okay?
Because we don't know what tariffs are going to do. We don't know what costs are going to do. But we don't know what Mother Nature is going to do. And can I share with you, if your coverage ratio is a little bit lower, John, than you desire, then you have to carefully look at some risk management programs. In other words, how can we mitigate the risk? In other words, livestock insurance, crop insurance, or should we fix our interest rates? So these are risk mitigators that can help beef up that coverage ratio.
Wonderful. Love it. Okay, great. Good. Do you know somebody that's wrestling with serious medical issues and all the expenses that go with it? If so, go to hiscavvyfoundation.com, Cavvy spelled CAVVY, apply or nominate them for assistance from the foundation, where we help people in the ranching business get through those things together. Let's keep going.
The next area is working capital.
Oh, man. My favorite words.
By the way, I don't care if it's a government, a business, or a personal household. The choke point of any business is financial liquidity. It's not about your net worth, et cetera, et cetera. And I know bankers will use current ratio, and they aspire to have 2 to 1. And it could be lenders, the Farm Credit, FSA. I like to look at working capital to expenses. And this is not just cash. It's things that can be turned to cash within a year. In other words, your accounts receivable, your inventories, your prepaids, et cetera, et cetera. One of the things that we aspire to do at the creamery, we like to keep it above 25%. So you know what it says? If your expenses are, say, $1 million, then we like to have $250,000 in working capital. We're about 26% right now. And that's your green light. Your yellow light's 10 to 25. Red light is under 10% because you got to remember, when you don't have that profit margin, you don't have that coverage ratio, your working capital is a lot like linebackers in football. In other words, it's the backup. It's the backup. And you got to remember, I'm going to say this term, and I know what you're probably going to say. Cash is
king.
Yeah. Well, I got straightened out about
Cash
5 years
flow
ago.
is king, I guess, is how we've
Well,
tried to
no,
model.
no. I had to go to Canada, and
Okay.
a lady from Royal Bank comes up to me, and she goes, Dr. Kohl, eh? And they say, hey, and about. She goes, I want to challenge you on your term, cash is king. I go, okay. She goes, I believe it's a queen. And I go, I want to hear you out. And she says, you ever played chess or checkers? Hey, growing up in a snow belt in upstate New York, I used to do that with my grandmother and grandfather all the time. And if you think about it, the most important player on that chessboard is the queen. The queen's
Interesting.
there to block adversity, take advantage of opportunity. And you got to think about your business as a series of moves. And to have that security so that, you don't have to sell when you don't have to sell, or you can buy when everybody else is not buying. And the important point is it's the queen on the chessboard. And again, that cash, I'll hear farmers and ranchers tell me, well, it's not earning that much in the bank. Folks, it's opportunity cap. Let's go back to Buffett. When I was there last year, not this year, last year he had 138 billion. This year he's got 325 billion in cash. Buffett is building. He says, in business, it's like going fishing on that stream. You don't go after every fish, you go after that trophy fish. And what will happen is working capital will help you capture that opportunity out there. In other words, when everybody else is walking, you run. When everybody else is running, you walk. So working capital, so critical. And can I just give an example?
You bet. Let me give a quick definition, though. I want to make sure everybody's on board. Working capital is literally the current assets minus the current liabilities. When we say current, you mentioned it before, short term. So think things like stock or cattle, feed, accounts receivable, cash in the bank, et cetera. Those are all current assets, the products that you expect to liquidate basically within 12 months compared to current liabilities. So this is your line of credit. This is a revolving line, those things that you need to pay in the next 12 months. We include in that the current portion of long-term debt.
Yes.
Is that okay? So this year's payment on the mortgage is part of the payments you're going to make in the next 12 months. We subtract those two numbers and come up with a dollar number difference between them. So let's say I have 100,000 in current assets, 50,000 in current liabilities. I then have a $50,000 working capital. And then you compare that to the total expenses, direct and overhead for the business, to come up with this ratio, the 25% you're talking about, right?
Exactly. And I like it. Normal depreciation, not accelerated depreciation.
Right. Book depreciation. Yeah. Okay, good.
Yeah.
So if we have a working capital of $50,000 and it costs us $100,000 a year to run the business, then by the way you do it, that would be a 50% working capital.
There you go.
Okay.
Yep. And again, I like that because we're 26%. You know what it says? We can operate on our buck for at least 90 days.
Yeah, for 4 months or 3 months. Yeah. Okay.
3 months. And if it's 50%, it's a half a year.
Yeah, 6 months. Okay, great. All right, go ahead with your example. Thank you.
Yeah, I guess I don't want to overwhelm your podcast, but those are three. Of course, I like to look at operating expense revenue ratio, excluding interest and depreciation. You go, why do you take out interest and depreciation? Well, sometimes we manipulate that depreciation, and then all farms and ranches don't have interest costs. It's a simple little thing. It's basically how much does it cost to generate George Washington? And a simple little thing. And I find that generally speaking, if you're under 75 cents to produce a buck's worth of income, you're rocking and rolling. Our data sets, I'm not talking about USDA data sets, I'm talking about the farm record systems where they're accrual adjusted. We'll typically see that the green lights are down in the 70%. Once you get above 85%, doesn't mean you're going to go out of business. it means that margins get thinner and thinner. And one caveat, some people will lease their farms and ranches rather than own. So it will tend to be a little bit higher because you're offsetting, the lease for the interest, et cetera, et
Yeah.
cetera.
Okay.
I like to make it simple. How much does it take to generate George Washington out there?
Yeah. No, that's fantastic. Good.
And I guess the final one is, you look at your debt to asset ratio or percent equity. When I was at grad school at Cornell, I'd come back home to our dairy farm in upstate New York. My dad only had third grade education, mom, ninth grade education. So he'd go, okay, boy, break it down. I go, well, Dad, you own 93% of the farm and the lenders own 7%. And he'd go, well, is that good? And I go, well, you need to step it up. But all joking aside, once that goes above 50-50 debt to asset ratio, above 50 or percent equity below 50, you're really going to have to step up your game plan. You're going to have to be a really good production manager, still being efficient. You're going to have to probably minimize your family living withdrawals. The third thing is you better have a good relationship lender. I worry about that because the more we move to scoring and various systems, and again, my doctoral dissertation was in that area. One of the things is that human element is so important. So I don't want to overwhelm your podcast, folks.
Mm-hmm.
Those are things that we look at our creamery, to be very, very candid with you. And we evaluate the coverage ratio on some of those and net margin every month.
Yeah,
But
great.
some of them you'll look at a semi-annual or annual basis. So you just got the primer. I was facilitator in the United States Farm Financial Standards Task Force. John,
Yes.
up until 1989, we did not have any of these ratios or anything for agriculture. And that's one of the things our task force developed, and now they're being used in the industry. And, you reflect back at my age in life, and that was one of the more rewarding things that we did.
Yeah, that's awesome. That's really good. Well, we have taken advantage of that, been the beneficiaries of that. And most of the things you have talked about today, these are what we work on with our customers. We do have additional webinars that go into detail on most of these. So we can talk more about that in the future. And I hope that our regular listeners are at least fairly familiar with debt coverage, working capital, net profit margin, and then we can go into more detail from there. So that is fantastic. Okay.
And John, can I just share with you, every
Please.
once in a while, I don't care how good you are, sometimes you need a refresher. Take things
I
from the back
agree.
of your mind
Yep.
up to the front of the mind. Even myself, I like to go listen to other speakers at seminars because, I go, gee, I hadn't thought about that, or I put it in the back of my mind.
Yep. There's another place here that we wind up thinking about a lot, which is some businesses are more naturally strong in one area versus another. And some of these things can be offset just a little bit. So maybe my working capital is exceptional and my debt coverage is a little weak. It would be ideal to have both of them very good. But there may be periods where we know we're going to go through a period where these are going to be a little off, but we have a plan there. And understanding how they interact with each other is very important.
Another question I kind of despise, what's your favorite ratio? I don't have a favorite ratio. It's like who's your favorite basketball player, football player? It takes a team.
Yeah,
and these ratios are in balance with each other. So I just want to reinforce your point that you've got to have balance. And we basically look about 5 or 6 of these ratios in balance.
Yeah. Very good. Yeah. And that's been one of the hardest things we've really tried to implement is how do you come up with a suite of ratios and then understand how to evaluate them? We know that if you have 4 out of 5 bad, like we're in trouble. What can we tolerate though? That when you're in the 1 or 2 of them bad, one is bad, one is okay, the others are good. Like that's a much harder place to sort of think through.
Well, and can I just share with you right now, the row crop, the grain crops, many of those ratios are starting to, show the red light over in the beef industry. It should be pretty green. But if you've got kind of and you got kind of a plan to basically weather the storm or take advantage of opportunity, and being able to execute that plan is so, so important.
Yeah, I love it. Okay, very good. Before we wrap up, is there anything you'd like to add? We'll wrap
No,
up for today, and then we're going to come back.
I really appreciate it, and
Good.
I appreciate this podcast, and I hope there are some, as people listen to this, kind of benchmark yourself, to some of these components. And I'll just say, there's not one size that fits all or one thing that fits all. Customize it to your situation. That's what's so unique about entrepreneurship agriculture. It's not one size that fits all or, one business acumen. And if you're not strong in some of these areas, this is where bringing on the advisor, the facilitator, et cetera, it's kind of like that assistant coach. But, the other thing that I'm starting to see is more and more folks are doing peer comparisons. And sometimes your peer, it's kind of like, did you work out this morning? No. Well, maybe you need to. It's kind of like the dog is kind of the, peer consultant, Those are some of the things that can help you implement these. And remember, respond, execute, and monitor. It's easy to check the box. It's more difficult to execute and then monitor. That takes what I call discipline.
Yeah, very, very good. And that turns, when we're looking at our financials, which are, inherently backward looking, that turns us towards, okay, what are we going to do about it? Maybe our working capital isn't where we want it to be. That's fine. What do we do in our business to get it so it's no longer a problem? Yeah.
Exactly. And
Good.
I have to forewarn people, oftentimes we'll look for a quick fix on working capital. We'll knock on the lender's door and say, hey, can we refinance and build my working capital?
Yeah.
Easy way out.
Yeah, it is. But there are other ways out. And we emphasize a lot the fact that for both risk management and working capital, margin is one of the best tools there is, right?
And I don't want listeners to get upset because in the row crop right now, occasionally you're going to have to refinance.
Oh, absolutely. That's right.
And we have in our businesses, but don't make it a habit. It's a hard habit to break.
It is. It is. Dr. Kohl, this is fantastic. Thank you very much for joining us. We are going to come back and talk about some softer topics here away from finance just a little bit, but thank you very much, and we will talk soon. Thank you for tuning into the Ranchnomics podcast. We hope this episode helped you win today. If you enjoyed this episode, please subscribe and share it with a friend.